Good morning, everyone, and thank you for joining us on today's quarterly MLP webinar. My name is Will Hershey of Yorkville Capital Management, and I will be moderating today's call. Joining me today from Yorkville will be Darren Sharinga, Jim Hug, and Len Edelstein. If you have any questions during the course of the prepared presentation, please feel free to type your questions into the submission box in the bottom right corner of your screen. We will hold a question and answer session at the end of the call, and we'll do our best to address everyone's question. If we don't address it during this call, we will be sure to reach out to you offline. With that, I will turn the call over to Darren, who will now proceed with some prepared remarks.
Thank you, Will. And thank you all for joining us for our quarterly conference call, where we discuss not only what's going on in the state of the MLP asset class, but more specifically for our MLP Core Income Strategy. Yorkville in current news, we're going to start off with this new segment here. Very briefly, we've introduced and made a couple of upgrades to our website. Many of you used our K1 tracker, which tracked all of the K1s being issued and helped make filing taxes for separately managed accounts easier, as investors were able to go to one place to locate all of their K1s and track them as they came out. We've made a couple more modifications and have a few more planned for the course of the year. We introduced our MLP performance tracker, and that was last week. It tracks the best and worst performing MLPs in the top chart, and if you look at the gold line at the end, it's probably one of the best arguments for active management. It's just the spread between the best performing and worst performing over any period of time. There's a lot of dispersion, so you can make a lot of money or you can get hurt. One of the interesting things of both of our new trackers here, you can sort by two criteria. If you look here, you can see that the sector is a different color, so we've sorted by sector, and then we've sorted by performance within that sector. And to do that, you press the sector, hold down the shift key, and sort by any other factor, and you'll be able to see by sector and then by period of time you're looking for in terms of performance. The second tracker is our MLP fundamental tracker. We introduced, it builds upon a concept that we used to look at risk across our portfolios, and we look at them according to 7 risk silos. So if you look at the table on the bottom, you see segment, sector, market cap, yield, distribution growth, distribution coverage, and net debt to EBITDA or leverage. We use these 7 silos to look at risk as we do above in pie charts. And so the top 2 pie charts are return. You're looking at your yield and your distribution growth. Your middle is market capitalization, and your bottom is risk, your coverage and your leverage within the partnership. Higher coverage better, lower leverage better, and then yield, higher yield better, coupled with higher distribution growth. So you can look at yield in a vacuum. Again, the sorting function by 2 factors remains. You can sort by segment, sector, and then by market cap, yield, distribution growth, coverage, or net debt. Simply hold sector down and click on one of the others. All of these are free. They're available on Yorkville's website at www.yorkvillecapital.com, and they're under the research section. So we have some exciting news. In last quarter or last month, we introduced our new mutual fund. And this is the first fund that Yorkville has introduced that's actively managed. It tracks the MLP Core Income Strategy, so it's the same exposure, but in a mutual fund format, so there's no K1s for investors. This will work well for smaller accounts or for investors that don't want the 1099 income. It is structured as a C Corp, which means that the fund then pays the taxes on behalf of the investors. So without further ado, let's take a look at MLPs, a quarter in review. We're looking at the first quarter of 2015. Asset class performance, you can see that MLPs, which is the third line or bar from the bottom, MLPs actually finished the first quarter down by 3%. And the way Yorkville looks at it in our universe indexes, our MLP universe indexes, we break it down into two main segments and then 10 sectors: the commodity MLP segment and your infrastructure MLP segment, which are basically half of the names are contained in each. Commodity MLPs, after really trading off in the fourth quarter of last year, had slightly positive performance in the first quarter of 2015. Infrastructure MLPs actually finished slightly down in the quarter, which brought the overall MLP universe or the asset class to show negative performance. And again, for you who aren't aware of it, Yorkville's universe, MLP universe index contains 100% of all master limited partnerships, so it tracks the entire population of MLPs. And then when you look at commodity and infrastructure between the two of them, again, it equals 100% of the entire population. So our indexes are a great way, and we believe the most accurate way to track performance as well as fundamentals of the MLP asset class. So overall, the takeaway here is MLPs had another negative quarter in Q1 overall as the asset class, and that falls on the back of Q4 negative performance. Fortunately for investors in Yorkville, we posted positive numbers in Q1. Asset class comparison, when you look at yields for the first quarter as of 3/31, commodity MLPs are yielding 9.6%, the MLP universe is yielding 5.8%, and infrastructure is yielding 5.1%. The spread between infrastructure MLPs and commodity MLPs is 4.5%. That is significantly above historical averages, where the asset commodity is traded relative to infrastructure. Another takeaway, if you look at the top three highest yielding asset classes, they're all MLPs. So from looking for investors looking for alternative sources of income, in this case equity income, you're finding the highest yielding options or investment alternatives coming out of MLPs over utilities, REITs, and the S&P 500. Master limited partnerships, despite oil's pullback that we experienced from the summer of last year through the end of the year and into the beginning of 2015, the fundamentals remain strong, and that's because MLPs have a different business model. It's a leasing business model versus volume times the price of a commodity. So what you see overall, the Yorkville Stability Score, which is published on the front page of our website, shows 8.9. What does that mean? That means that 89% of all partnerships maintained or increased distributions. Another way of looking at it, 11% of all MLPs cut distributions in the most recent quarter. So of the cuts, the 11% that cut their distribution, two sectors, exploration and production and natural resources, both that fall under our commodity MLP segmentation, were responsible for virtually 100% of the cuts. The growth score across the asset class in the Q1 came in at 3.7%. And what does the growth score measure? It measures distribution growth on a year-over-year basis. So stability across the asset class remained very high, and MLPs, despite of the pullback in oil, still delivered positive distribution growth on a year-over-year basis. Why invest in MLPs now? Well, there's a number of different reasons. Some of them are why now, and some of them are why at any time you'd want to invest in MLPs. We looked at, this next slide looks at energy equities and their performance since crude oil peaked in June of 2014 through March of 2015. And the top line is MLPs, and then you have energy stocks as measured by the S&P 500 energy sector, and then exploration and production companies. As you can see, MLPs were down 9.6% versus energy stocks in general, which were down 22%, and exploration and production companies, which were down 40%. MLPs are a great way to invest in the U.S. energy revolution without the commodity exposure. As I mentioned on my earlier slide, that's because it's a different business model. Energy companies are ultimately driven by this, price of the commodity by the volume of that commodity produced. So if the price of the commodity goes down, revenues will drop, profitability will drop. MLPs, it's leasing capacity. It's more of a real estate business model. So it gives investors downside protection in terms of price, which we can see here, as well as fundamentals, and I'll touch on that in a moment. We also looked at whether this relationship between energy and MLPs was only for this most recent pullback or if it held true historically. We looked at the top 10 oil declines since 2000. We can see that oil has dropped on average 37, almost 38%. MLPs during these peak to trough drops of the price of oil declined by 5.3%. Again, relative to the commodity, MLPs provide great downside protection. And we looked at, in these 10 different scenarios or oil declines, what happens with oil after its trough for the next 360 days or a year. Energy generally pops about 37%, and MLPs generally increase by 27%. So you're capturing a fraction of the downside, 5% versus 38%, and you're capturing the majority of the upside. So it's a wonderful risk-return characteristics that MLPs provide relative to other energy investments, and in this case specifically oil as a commodity. The next chart deals with the question of MLP, this different business model, this leasing business model providing fundamental protection, which means stable and growing cash flows over time. So I'm going to try to simplify this graph in front of you. The line running through it is the price of oil, and it relates to the right axis, which is $25 through $95. That's your price per barrel. And then the bars going up through the graph, the darker bar, the green bar is your MLP distributions, and your gray bar is your earnings, your energy earnings from the S&P 500 energy sector. So let's just focus on 07 through 09 on the chart. You see that oil peaked in 2007. It troughed in 2008. If you look at energy earnings in 08, energy companies, their earnings peaked in 2008, and then a year later, the earnings crashed and really followed the down, tracked oil, but just tracked it by a lag time of essentially 1 year. The MLPs, look at the difference on a fundamental basis. 08, 09, the green line again, essentially flat. In fact, it was approximately a 9% pullback in earnings. And 89% of all MLPs, again, maintained or increased their distributions over that period of time. Look at it, 2010, 11, 12, 13, and 14, straight up, MLPs cash flow, and this is distributable cash flow that investors have received, has grown every year and reached record levels since then. The earnings from energy companies, they still not reached the pre-crisis peaks, and in fact, it flattened out over the past couple of years. So again, this business model, this MLP leasing business model, provides not only price protection, but also fundamental protection. So supports our thesis of why MLPs are a great way to invest in the U.S. energy revolution, getting the growth, but not getting the volatility of commodities. The final reason today, at least, is the current valuation is supportive of superior returns. The pullback in MLPs has caused a dislocation. It's provided a great entry point. And to simplify this chart, you move to the right, to the far end of the right, that's when MLPs were cheapest. You move to the far end, to the left, that's when MLPs were the most expensive, so keep that in mind. To the right, MLPs were cheaper. To the left, more expensive. The bars going up are what's the spread? And this is the measurement of the value of MLPs, whether they're expensive or cheap, the spread relative to treasuries. As you can see, most of the observations, or most of the time, MLPs trade in a range between 200 to 400, and those are the first green bars that are the highest. That's most of the time where MLPs are trading on a spread basis. As of 3/31, you can see the MLPs were towards the right end of that scale, and there's not many times that MLPs have traded cheaper than this. So on a relative basis, MLPs are looking relatively cheaper than they have historically. And the line that runs through this chart is really the most important part. When MLPs are more expensive here to the left, returns are low to negative. When MLPs get cheaper to the right, where we are currently, MLP returns are better. So we have another reason to invest in MLPs right now. We have good valuations, and when we see MLPs trading at these ranges or have historically, generally they've produced positive returns over the next 12 months. So a macro perspective on oil, we have to touch on that. We've just gone through an extremely volatile period of commodity declines. We touched on our last conference call. Globally, we are oversupplied in terms of oil. So global demand is at 93.3 million barrels per day, and global supply is at 94.4 million. And these numbers vary depending on the source slightly. So we find ourselves in an oversupply situation that's universally agreed upon, roughly 1% oversupply. So not a large oversupply relative to the amount of demand. One of the points I'd like to make to investors is when you look at 08 and 09, the Great Recession, the global financial crisis of our generation, at least we hope it is, the global demand and demand destruction, oil demand globally only dropped by 3 million barrels. It's using an economic expression, demand is very inelastic. There's no substitution for oil in the production of energy at this point. And so demand remains pretty constant even in a Great Recession like that. So we're going to bring the world to oversupply back in either by growing demand or cutting supply. What we've seen in the U.S. is a dramatic response to the pullback in the price of oil. Rig counts, if you look at this line on the right showing negative 56%, these are the number of rigs in the United States that are being deployed for drilling activities, has declined by 56%. If you look at it on an absolute basis, again, going back to 08 or 09, the last big drop we witnessed here, in magnitude, it's almost the same. On an absolute basis, rigs are back down to levels that were last reached in 2008. The U.S. has had a rapid response to the decline in price of oil. What you would expect in a great forecaster, why are we looking at rig counts? Rig counts decline, drilling activity declines. What would you expect? You'd expect production to decline after drilling activity has declined. Right now, we're seeing production levels at 30-year or 40-year highs at 9.2 million barrels per day that the U.S. is producing. What is incredible when I look at this chart is that the amount of growth that we've seen, we're at record levels for 40 years, number one, that globally there's been 3 million barrels of new supply brought online. If you look at the growth in the U.S. from 6 to 9 over that 3-year period, the U.S. is responsible for 100% of the global growth in oil. This is all wonderful for MLPs, and as Len likes to call it, are the veins and arteries of the U.S. economy, and I think that's even more accurate. I'd say the transportation system, but oil, as we said, and looked at demand, it's the lifeblood of the global economy. So all of this growth is very good for MLPs going forward. The fact that the U.S. has responded rapidly to a decline in price should, what we believe, will flatten out production coming into this year. And as we've seen recently, and why oil prices are coming back up, and today they're over $60 a barrel, is what we've seen is demand out of Europe and other locations in China has been more robust than initially anticipated. Again, there was a fear of a recession, a global recession. Now that has been lifted again, and we're seeing demand come back in stronger. So the demand side is growing. We see flattening in supply. It should bring the oil back into to balance sometime in 2016. On to our core income strategy. And really this is talking about what have we done for our investors lately, and probably why most of you are on this call. So if we look at our first slide, MLP Core Income, delivering fundamental alpha. We view these two scores below as our report card, and really they're answering the question to you as our investors: are we delivering on our investment objectives for the strategy, which the first investment objective is stable distributions. Don't cut distributions across the strategy. Number two, growth in distributions, clearly identifiable catalyst for future distribution growth. And what you see here on the stability score, so the quality of distributions across our portfolio, there were no cuts. 100% of the names in our portfolio maintained or increased distributions. This is something that we've been delivering for investors for a great many years. In fact, in 08 or 09, if you look, 100% of the names in our portfolio in the worst downturn, again, maintained or increased their distributions. So that's one of the elements of what we define as fundamental alpha. The second is our growth score. What are distributions growing at across our portfolio? So average distribution growth across our portfolio for the first quarter was 23.8%. This is cash on cash. What do I mean by cash on cash? This is the amount of money investors would have received last year. How much has it grown this year based on the investments in the portfolio? So if we continue or any investment grows at 23%, you are ultimately doubling the amount of income that investment is going to produce over a 3-year time frame. And that's the power of growth that we're seeing out of MLPs. Again, it relates to, on a macro level, the growth in production that are coming out of these new energy frontiers in the United States. So our scorecard, 100% of the names maintained or increased distributions, and they grew their distributions on average by 24% on a year-over-year basis. The MLP Core Income Strategy, current yield, the MLP universe is yielding 5.8%. Our core income strategy is yielding 4.8%. So you can see that it's yielding slightly less than the broader universe, and that's an offset for, as this next slide shows, greater growth. And as Jim and Len have stated for years, both being pioneers of investing in the MLP asset class, they have, and Yorkville as a firm, we view it as a total return investment strategy. We love high current income as long as it's high quality income and the income is growing. The way we view it is we're looking for growth in income. We're looking for a total return investment in MLPs, because by combining current income, high current income with faster growing income, we maximize the total return potential across the asset class. This next slide, page 22, does a comparison. The gray lines are the Yorkville MLP Universe Index, which is really representative of the entire asset class. It's 100% of all MLPs. The yield was 5.8% versus 4.8% for the MLP Core Income Strategy. The growth across the asset class in the first quarter was 3.7% versus 23.8%. Back of the envelope calculation, add yield plus growth together gives you a total return potential. So the asset class, 5.8% plus 3.7% is 9.5%. Total return potential, wonderful. That's what equities have done historically, where our fundamental alpha hopefully translates into performance alpha or total return alpha. 4.8% income plus 23.8% distribution growth produces or has a potential of producing 28.5% back of the envelope calculations. So a much more compelling investment opportunity just using this simple analysis of what total returns look like for the two strategies or two investment alternatives going forward. As you can see, Yorkville has delivered on returns, not quite as high as the most recent quarter would indicate, but not too bad. And over a 5-year period, our total returns have been 24% per annum relative to 13.8% for the asset class. That's 10% additional alpha or outperformance on an annual basis. So it's proof that investing in growth is really a virtuous way of gaining access to the MLP asset class. You can see that number holding true over a 3-year basis, 22.1% annual performance versus 9.2% for the Alarian Index. And even over a shorter term in the first quarter, well, this is what 1 year trailing, the strategy is up 2.4%. The Alarian is down 2.5%. In the quarter, it's even more dramatic. We were up 4. The Alarian was down 4, so we've delivered about 8% outperformance in Q1. So the last slide here on performance, it just again looks at 1, 3, and 5-year numbers, annualized returns since inception, which again, it's just consistency of our process applied over time produces consistency of results. We're looking to identify partnerships that have a very low probability of cutting their distributions with clearly identifiable catalysts for future distribution growth. If we continue to find partnerships in a company-by-company analysis and we put them into a portfolio, we're going to build a portfolio that will deliver to investors a best-of-breed performance. Stable distributions, not cutting their distributions with distribution growth, which is exactly what we've been delivering. So Yorkville, when you think of us as an MLP manager and the core income strategy, it's a blue chip growth investment. Yorkville, our total return strategy, we really are growth investors within the MLP asset class. We always have been. We look at it not for income, but for total return. And with our new MLP mutual fund, the Yorkville MLP fund, it gives investors the ability to access our active strategy now in a 40 Act product that wasn't available before. So we're very excited to be putting that out to the market. That is it for my formal remarks today. We're going to open it up for Q&A.
No, thank you, Darren. Very informative presentation. Just want to remind everyone, we do have some questions already in the queue, but just want to remind anyone, feel free to type any questions you may have into the submission box in the bottom right corner of your screen. And with that, we'll give Darren a little bit of a break and turn it over to Jim for one of our first questions here. Just generally speaking, do you see any potential for long-term problems in the MLP space?
Well, over the years, it seems that there have been 3 macro problems that have come up from time to time. And the first is we're going to run out of fossil fuels. Now, I think Darren articulated in the last 20 minutes why that just isn't going to happen anytime in the near future, intermediate future, or the distant future. I mean, this all started back in the 1990s when George Mitchell began to experiment with fracking, and then in 2005, 2006, we began to experiment the E&P companies with horizontal drilling. And we all know what the results were. We have seen it, even if people don't follow closely what's happened to oil and gas. The shale and shale oil and shale gas drilling revolution, has been remarkable to say the least. So I think the idea that somehow there's a finite amount of fossil fuels is just isn't true. There was a famous bet years ago between 2 economists, Julian Simon and Paul Ehrlich. And Ehrlich bet that a number of commodities were going to skyrocket in price, and Julian Simon took the other side of that bet, and guess who won? Julian Simon. So I just think that the idea that fossil fuels we're going to run out anytime soon is a problem that has been solved. The second thing is that people often bring up is the challenge of renewables. And as the price of oil and gas has come down, renewables, which weren't competitive to begin with, have become even less competitive, and the only reason why they can really provide any challenge is simply because of subsidies from the state and the federal government. So I'm not concerned about the challenge or the competition from renewables. And one kind of interesting thing is that it's been estimated that if solar energy was going to provide all the electricity in the United States, Texas, Oklahoma, and Kansas would have to be covered with solar panels. So it's not exactly a very efficient renewables aren't exactly very efficient. If they become more efficient, fine. There's nothing to say that MLPs in the future could not have renewables, and there's a act that is rattling around in Congress. I don't know where it stands right now, that the senator from Delaware, Chris Combs, and Lisa Murkowski, the senator from Alaska, one former being a Democrat and Murkowski being a Republican, would like to have passed into law, and the Parity Act would allow renewables to have an MLP status. So if it comes to it and renewables do become competitive, great. That'll just be another avenue for MLPs to be created and for investors to invest in. Finally, and I'm just going to touch on this briefly, you have the environmental challenge, in other words, known as climate change. And this is a very emotional topic, and for some, it almost becomes a religious discussion, and we're not going to get involved in a discussion of religion. The one thing I would say is that there have been estimates made that if all of the greenhouse gas emission restrictions were put in place, that by the year 2100, it would lower the temperature by 0.03 degrees Celsius. So as far as the climate change argument, I don't think it's really going to have any lasting impact. We need fossil fuels to fuel the economy, and as Darren and Len have said, they are the arteries of the U.S. economy, and I think they're here to stay for the foreseeable future.
Thanks, Jim. Another general question here relating to energy overall. David Einhorn made a bearish argument against fracking. I believe that was at the Sohn conference just a couple days ago. And I'll let Darren handle this one. What do you anticipate in terms of U.S. oil production and fracking over the next 5 to 10 years?
Okay. So we use history as a gauge. We've seen that earlier in the presentation, the U.S. has increased its production at 40-year highs. Over the past 3 years, we've seen 3 million barrels of new production come online, and that 3 million barrels represents 100% of the new production coming on globally. With not a Yorkville statistic, but just a generally accepted estimate, is that the U.S. will be producing somewhere in the range of 16 million barrels at the peak of this cycle of oil. And so I think that could be, is very doable and may even be conservative. So the potential of doing 16, 18 would not only make it the largest energy producing country, which it already is, but the largest oil producing country by far. You see a doubling almost a doubling in current production, and I think a doubling is probably reasonable from current levels. So that means a tremendous amount of demand for new infrastructure in order to move and transport from new energy frontiers, from wellheads to processing to the end users within the United States. So I see a tremendous growth profile in the industry going forward that parallels something that we would have seen in the past. And just even to make it not so theoretical but very practical, had the rig counts not dropped by 56% this year, the U.S. would have added another 1 million barrels of production. So we have the capability of, through these unconventional shale plays, of producing a lot more energy. That's number one. Number two, and why I'm excited about the U.S. position as a energy provider long term, is that roughly we are recovering in the United States from unconventional shale plays 10% of the total resource in the ground. So if it's 100, we're getting 10 out of the 100. When we look at vertical drilling, which is the traditional drilling, vertical drilling, we're pulling up 80 to 90% of the resource. So if it's 100, we're getting 80 to 90 out of it. What we've seen is a tremendous amount of increase in the productivity. So our productivity here is measured as our ability to pull more of the resource out of the ground. And by adding more frac sand to the process, we've actually seen recovery rates on wells increase by 25%. So if recovery rates, and we're able to move towards this, 10% to 20%, we've just doubled the amount of resource we're taking out of the ground. It's not a perfect correlation, but you're almost cutting your price in half. So 60 becomes $30 per barrel, and if you increase 20 to 40, which is still only half of what we're recovering from horizontal drilling, you now are looking at producing oil at $15 per barrel range, and this is incredibly cheap on a global basis, and no one else has the potential to increase productivity across their oil resources like the United States does. If my magnitude's a little off, I'm simplifying it, but the point is there is Moore's Law, which is a computing law that's happening here within the energy space, and it'll be a very powerful and transformative for the United States going forward, and so that's what we see. We see a very bright future for energy going forward, and fracturing will be the way we're going to get there.
No, Darren, that was really a helpful answer there, and I think for those of you that were able to catch Einhorn's presentation, what he failed to address is what you're referring to there is technological advances will really take us to the next level in terms of production. Actually, another very timely question here. Any thoughts on the proposed IRS PLR ruling, a number of names gapping down on the news? I'll just actually take that question. So for those of you that aren't aware, MLPs need to source 90% of their income from what's called qualifying sources, and the IRS potentially was looking at expanding that definition of what qualified into some other areas. So it looks like that is not going to be the case, not going to happen. So as a result, there won't be any chemical MLPs or paper company MLPs. So that's what's affecting those companies there. With regards to the MLPs that are currently in existence, so long as they're retaining that 90% threshold from the qualifying income, I wouldn't expect it to be a material impact on their, on their asset base in any way. But good question, very timely.
And I'd like to add to that, Will. None of the names in our portfolio are impacted by the ruling at all. So it's another argument for active management. There are areas, just the spread that we showed in the price performance. Investors can be hurt in MLPs. Not all MLPs are created equally. So active management is really beneficial in this asset class.
No, absolutely. And that actually, with regards to the portfolio, brings us to our next question here. What would you say led to the outperformance thus far this year, and how does Yorkville think about how it's currently positioned going forward?
Okay, I'll field that. We looked at energy in the most recent pullback in the global oversupply as, on a fundamental basis, would take a little bit of time to to get back into balance, and it will. Now, we've seen oil move ahead of that, which the markets always anticipate where the future. They don't wait for it to happen. Our portfolio is almost 100% in infrastructure names currently, and it is 100% in names that are, except for one actually, it is 100% in names that have long-term contracts tied to their cash flow. So in stress testing our portfolio, we're very comfortable that it had almost virtually no commodity exposure, so that you could bring commodity prices down to oil prices down to $30 a barrel, and the distributable cash flow across the portfolio would still be about 15% per annum over the foreseeable future. And we view that as over the next 3 years. So a tremendous amount of cash flow generating potential from the companies within our portfolio, the MLP Core Income Strategy right now, that are absolutely, given their different business model, this leasing business model, not tied to the price of commodity over this period of time. So we're very comfortable with the growth potential we're putting forward across the portfolio. We believe it's as insulated as it could be to commodity prices currently, and that is basically where we stand.
No, great. And the next question here, I think, is one that we've received every year for the last however many years. So, Jim, I'll let you take a stab here. Would a rising interest rate environment represent a minor or major threat to MLPs as an asset class? If yes, how would you look to offset this risk?
Well, I think we've done studies. Yorkville has done studies, and other investment firms have done studies going back to the mid-90s or even before then, and correlating what's happened to the performance of MLPs and interest rates. And I think in the study that we did, I think there were 7 periods, Will, that where there was a rising interest rate environment, and I think in 6 of those 7 periods, MLPs actually rose. So it's something that we're mindful of, but I really don't think that that this is something that we're terribly concerned about. And I just believe that the fact that history has shown that that there's not been a negative impact on the performance of MLPs, I think makes us feel pretty comfortable about what will happen when interest rates do in fact start to rise.
Yeah, no, thanks, Jim. And I think one other really important point to add to that is what we've really been focusing on in this presentation, which is growth. MLPs offer distribution growth that serves as a hedge against inflation, a hedge against rising interest rates. Obviously, as Darren discussed in the presentation, it powers the total returns of the portfolio. And I think that's something that if you're looking at other income alternatives in equity space like a REIT or utility, you may be more exposed to interest rates for that reason. You're not getting that same kind of growth in distribution.
And let me just further add, I think investors sometimes make the mistake of comparing an MLP, as a substitute for a bond. Bonds have their place in portfolios, but MLP should not be looked upon as a substitute, for a bond, for the reasons that Will and Darren have elucidated, and that is because over time the increase in distributions are going to quote unquote bail you out in a rising interest rate environment.
Sure. Darren, this question I believe refers to commentary made during the prepared remarks section. You said that demand is very inelastic as it relates to oil, I believe. But the reason that prices have gone up is that demand is higher than was previously expected in Asia and Europe. How can you reconcile these statements?
Okay. the inelasticity of demand was a measurement on the downside. So the base load demand is what I was referring to in looking at the downturn of 08 or 09, and that there is a incremental demand, a stimulative demand from lower cost of energy that will come in. People will drive more miles if oil or gasoline, for that matter, is cheaper. So that's how I reconcile the two. It's just in a downside, there's just base load demand that powers the economy, and then there's incremental demand that's discretionary.
Sure. A couple of you have asked, just before I go on to the next question, a couple of you have asked about when the slides will be available. The slides and the recording of this presentation will be posted to our website within the next couple days. So if you just will check back there, it will be posted on our homepage. Moving on to another question, how is the new mutual fund that tracks the MLP Core Income Strategy structured? Is it a registered investment company?
Okay. So the new mutual fund is not structured as a RIC for tax purposes. So it is a registered investment company. It is a mutual fund, but it is for tax purposes because it owns 100% of MLPs, or in fact the threshold is if greater than 25% of the portfolio is invested in master limited partnerships, it must be structured as a C Corp for tax purposes, which means it pays federal, state, and local income taxes, or if it doesn't pay them, at least it accrues for federal, state, and local income taxes. So the James Alpha Yorkville MLP Fund is a C Corp structure. It is the oldest MLP fund structure in existence, and it represents a C Corp structure. There's $60 billion roughly in MLP funds currently in the market, and roughly 2/3 of those are C Corp structures. So that's the structure of the new MLP mutual fund.
Great. Jim or Darren, I'll let whichever one of you wants to answer this question take a stab at it. Why did MLP distributions continue to increase over that period, Darren, that we looked at in your slides over the course of the last 10 years? How were they able to consistently produce growing distributions, or the MLP equivalent of earnings, if you will?
Well, there are a couple of reasons. I mean, there are demographic shifts, which means that pipelines and storage facilities have to be moved around to satisfy people moving from one area of the country, to another. Probably more importantly, there are new fields that are being exploited. I mean, who really would have heard of the Bakken field a number of years ago? And you need the infrastructure there to get the oil and gas out of Bakken or any other field. So which is why the MLP industry is not it's not really a static industry. There are a lot of moving parts, and these partnerships take advantage of the demand of their services that they need.
Sure. Another question, very macro, and I'm not sure if a question came in wondering where we think oil prices will be over the next 5 to 10 years, and we don't have any sort of crystal ball there, but I will just offer that based on Darren's description of the portfolio and the way that not only we invest our MLP assets, but we believe that everyone should invest, is construct a portfolio that allows you to be agnostic, generally speaking, as to where oil prices are headed. As Jim mentioned, MLPs were able to increase their distributions over 2008, 2009, even when oil dropped from 140 to 40, because there's a continuing need here for infrastructure in places like the Bakken. So I think we're gonna stay away from that question for now, answering it directly, but indirectly just.
You know, I would say one thing, just on a fundamental basis, Will, when I look at oil prices, I'd say that there's a new normal that's settled in on the pricing environment right now that has, and that's dropped it from say 80 to 100 to 60 to 80, so a significant decline in pricing. And the fundamentals that support the argument here are, until global demand or incremental demand outstrips the U.S.'s ability to meet that demand and the cost that the U.S. is able to produce oil at from its unconventional shale plays and the marginal unconventional shale plays, which right now is $60 a barrel. And if you look at the E&P companies, the forecast this year for drilling, we're based on $55 oil. And so if the pricing needs to support at least the cheapest supplier right now, which is the U.S. on a global basis, if global demand outstrips the U.S.'s ability to meet future demand, you eventually will see a step up in cost again, because the first supply that came offline here was offshore, deep water, and that's the most expensive oil. Brazil, to produce their fields, their deep water fields, they need over $100 oil. So once that happens, again, this is why I like the U.S. long term, the price will be set by incremental supply. And so all of a sudden incremental supply comes on at $100 a barrel and we're producing for something less than 60. It'll be the U.S. will be a very profitable place to be producing energy from. So I think currently you have a new normal. Once we're in this oversupply situation, as global demand picks back up and exceeds the U.S.'s ability to meet global demand, you'll see a step up in pricing at some point in the future.
Great. Just more of a request than a question, but could we just review briefly slide 13 with a couple minutes here just before we're heading on to our 1 hour mark. So I will move us back so everyone can follow along here to slide 13, and Darren, if you would just walk us through what we're looking at. A lot of really good information on this slide, but it is a lot to.
It's busy. There's a lot. So let's simplify it. And if you look at the line going up from the lower left, the gray line, to the top right, that's the return over the next 12 months. And it's the return over the next 12 months when MLPs traded at different valuation levels. And the different valuation levels are measured by these bars. And so the low bars here, 0 to 49 on the very far left, that's when MLPs were the most expensive on a spread basis. So when MLPs were most expensive, you actually saw negative returns over the next 12 months. So go to the very far end, when MLPs had spreads of greater than 10% relative to treasuries, and we would have witnessed that back in 08, 09, you saw 80% return over the next 12 months. And we had that observation once in the history. So that's the return when we saw spreads of 10%, 80% returns. When we saw spreads of 0 to 49 basis points relative to treasuries, we actually saw negative returns. And that's on average. So what's interesting, most of the time MLPs trade in the spread range between 100 to 150 to 200 to to 450. And that's the majority of the observation, those tall green lines. As you see, right now the gray line is where MLPs are trading recently, so it's at the outer end, which means the spreads are higher, meaning MLPs are cheaper than where they trade historically. And then if you go down and drop down to where the gray line intersects, the gray bar intersects with the line, that shows you when MLPs trade at spreads of between 450 and 499 relative to Treasuries, performance over the next 12 months on average has been around 20%. So that's all that this chart is showing. On the extremes, when spreads are really high, you get wonderful performance. When spreads are really low, so you get performance that's actually historically been negative. And right now we're trading at the higher end of the spread range.
Sure, so you'd expect returns above average, all else being equal.
All else being equal, it's a good entry point is really what it represents.
Thank you, Darren. So with that, we are just going to wrap it up here. We're approaching about the hour mark in terms of the time on the call. If we tried to answer every question here, if there are any outstanding questions, feel free. You can reach us via email at info@yorkvillecapital.com, or if you prefer, you can give us a call directly at 212-755-1970. So just once again, want to thank you all for joining us on today's call, and we look forward to speaking with you all again soon. Thanks and take care.